Morning, ladies and gents. It's Simon Brown here for our second in the Meet the Managers Actively Managed Certificate series. We've got two managers today. Our third, unfortunately, unable to make it. A last-minute cancellation there, but we are back next week. We've moved them to week 3, so they will pop up then. Two this morning, Differential Capital, Standard Bank. They're obviously managing the AMCs, but they've also got some of their own at the same time. Quick highlight of what an AMC is. I know I touched on this last week, but there might be some new folks who've come in. In essence, think of it as a kind of like a unit trust, but trading on the JSE, an actively managed certificate. So the fund managers, the asset managers, they are buying and selling. It might be local, it might be global, it might be a blend, it might have different asset classes in it. The beauty of it is that we can buy it nice and easy in our JSE account, and that really is the key point to it. We've got Musa. We're going to kick off first from Differential Capital. As I say, if you've got questions, drop them into the Q&A box. We've certainly got some time for questions, so we're happy to take some there. Musa, let me just get the right screen up, and there we go. Musa, floor is yours.
Great, thanks, Simon, and good morning to everyone. So I am Musa Marandla. I am one of the co-CIOs at Differential Capital. So Differential Capital is a hedge fund, an asset manager started in 2019. We manage several funds. So we have our Differential Gradient Fund, which is a hedge fund, the unit trust structure. The Neural Fund, and then we also have various segregated mandates. Now we've launched 2 AMC products, a hedge fund product and a global equity fund product, which I'll touch on at the end. I'll just jump into to some of the facts about what we do and who we are. If we just move on to the next slide. So the chart at the bottom just shows our performance over time since launch. So when we launched this fund, and in fact, this gradient fund, the hedge fund, is one of the AMC products. It's a mirror of this particular fund, which is our flagship. The idea behind it is to deliver returns that are stable, but also protect on the downside. In other words, when markets are correcting downwards, you want that, that protection, but still a smooth ride along the way. And in the 5+ years we've been doing this, we've pretty much delivered on that product promise. In terms of the product itself, we've in 2024 won the best hedge fund of the year for the multi-strat category. We also, as a firm, tier 1 clear pass rated. What that means is that in terms of our reporting to clients and so on, the quality and thereof, we are tier 1, and this is a global company assessing this. And then you'll see later, we use a lot of AI and technology in our investment process. It's really man and machine working together to solve this investment problem. And in that regard, we, in 2024, received the Best Technology and AI Award in the industry. So we are quite proud of those accolades. Now, moving to the next slide, in terms of the team who are actually doing this. So we are led by Vincent Anthony Raja. So he's the CEO and co-founder. Vincent, in his previous life, was Chief Analytics Officer at Momentum Metropolitan, and before that, he spent over a decade in the sell side, top rated across multiple sectors, banks, property, insurance, and so on. The co-CIO on the fundamental side is Sam Moody, who has roughly 3 decades in the market, so he's familiar to many people in the industry. CFA, CA, previously Counterpoint, and a few other houses. And then you have myself. I am the co-CIO on the data science side. In other words, the implementation of AI and tech into the investment process. I've been in the market for 13 years. So in the past, I started my career in banking, building models for various, for regulatory capital impairments and so on, and I moved on to be a well-rated sell-side researcher. So I was covering the insurance sector, whereas now I'm one of the co-founders on the fund, looking after the data science piece. We also have Jeremy Negoran, who's important in terms of what we do. So because we deploy a lot of tech and models, you can't run them on local machines on spreadsheets. So we use a lot of cloud infrastructure and so on. So Jeremy is our chief technology officer. And in the past, he was a senior member at Momentum Metropolitan, and before that, he was building infrastructure for many of the banks in South Africa. The investment team in total has 8 people plus Vincent and, in fact, Mark Salmon, who heads our special situation funds. Both used to be top-rated analysts. They contribute to the investment team as well. So it's 10 in total. So that's enough about the team. So if we go on to what we actually do on a day-to-day, how we actually invest in the next slide. So in the market, what we are looking for are 3 basic types of mispricing. So that informs when we come in the morning, these are the things that we are looking for as investment professionals. So the one is what we call information mispricing. What this is we believe and we have seen that in the market, only a small fraction of the information that's freely available is actually used in the investment process. So we've invested a lot of time in sourcing alternative data. So data that many investment professionals either ignore or don't know how to access it because of technological constraints. So that's an important part of what we do. In other words, having better data allows you to make better investment decisions. The second piece is we've also noticed that when given data, different investment houses will make different levels of quality investment decisions. So having data doesn't mean you make better decisions. And here we've seen over time that building models to process this vast amounts of data is actually a useful advantage in markets. So we rely a lot on in-house models that we've built to help screen for ideas and help us execute in terms of portfolio construction and so on. The last piece we've noticed is that there's this, we call it a preference mispricing. In other words, many investment managers will invest according to a predefined style. There are value managers, there are growth managers, quality, etc. The problem with that is at different phases in the market, in the market cycle, different approaches to investors, so different styles will perform differently. And this is well known in the literature. And the point is, by locking yourself into one style, it means that you're slow to switch. In fact, in many cases, you can't even switch to a style that would benefit your clients in that particular cycle. And that the way we solve that particular problem is that we are style agnostic. So we invest based on data, not on style. And style then becomes a residual outcome. There are moments in time where we'll be looking very much like a value manager, growth manager, quality, etc. But that's an outcome of the data and how we make decisions, not a targeted outcome. In terms of the investment process itself, if we move on to the next slide, there are basically 4 steps, and you'll see across it's man and machine working together across the cycle. So how an investment idea starts is as a screened idea using our AI model. So AI will basically screen ideas. It's constantly running, and it will suggest a few buys and a few sells in any so overweights, underweights, longs, and shorts. Now, in the next step of the process, we then hand over those ideas to the humans, and the humans perform due diligence. And the presumption here is that AI is only as good as the data that goes into it, and there are certain types of data and certain types of insights that only humans have, right? So sitting across a management team and appraising them is one thing that AI simply cannot do. It can help you figure out where to look, but in terms of doing due diligence, digging, looking under the hood and so on, that's something that we leave to the investment team. So ideas come in, and the fundamental team validates, either confirms or denies the recommendation that comes from the idea. And that's why we need the vast amounts of experience we have in the investment team, the 30+ years of So roughly 30 years in our co-CIO on the fundamental side. So all of those are useful in terms of appraising investment ideas. Now, when it comes to finally putting the portfolio together, so once the idea has gone through all of the different steps of the fundamental analysis process, it needs to then be placed in a portfolio. We'll have a long list of candidate ideas that are generated by our investment team with the help of the AI models. We now need AI to figure out the best way of combining those into a portfolio that maximizes return while controlling the risk. And at its core, you can think about, for those who are quantitative, you can think about it as a type of mean variance optimization, but it obviously gets much more complex when you're in the hedge fund world, when you're thinking about longs and shorts and derivative protection and so on. So those are things that are built into the process, but we also allow for human flair. Now, there's a lot that simple mathematical optimization will never really understand about. So that there's a lot of control that the fundamental team will still have over sizing of the portfolio that comes out of the machine process. And then the last piece, which is actually really, really important. In fact, it was at the core of when we started the business. We believe that if we do all of those first three steps right and use AI and data science and technology in the right way, we'll end up with a lot of time to engage. And engaging is the one thing that will never be competed away with by AI and technology. It's that sitting across the team from a management team and driving change is actually a meaningful thing that we focus on. You might see our name, some of the things that we do in the market floating around in the media. It's something that we've always believed in a lot. And interesting enough, the kind of data that comes from our data science process actually helps us a lot in terms of how we engage. In other words, we are engaging from a position of information rather than ignorance. So that's the investment process in a nutshell. If we move on to the next slide, what I thought would be a good idea is just to give you a simple example of how we make an investment decision, what I call the anatomy of an idea, and the perfect example that we've spoken about in the media in the past is Pick and Pay. So Pick and Pay, obviously, I think would be a story that's familiar to many of us. We were structurally underweight for most of the last 5 years until towards the end of 2023, it started being flagged by some of our models. And again, it was an idea that was simply being suggested to the team by a model to say, this is an interesting idea, have a look. Now, we started to look at it, last quarter of 2023. We eventually made a decision to enter the position around December, early Jan. We were building up a position. And I show there what now for a normal asset manager, they would have said maybe, so if it's a style, biased investment strategy, they would have said maybe it's not a growth Pick and Pay has no growth prospect. As a growth manager, I'm not investing. Maybe a value manager could have said, it's value, it's cheap in terms of its earnings multiples. Therefore, let's maybe think of building a position. For a quality manager, maybe they would have invested on the basis that there's a new CEO coming in and so on. In our case, what we're investing in is because we had data that signaled that there was a change that's coming to the prospects in the company. And I'll talk to that in the next slide. But before that, you'll notice we entered, but we suffered quite a bit, right? So, we suffered a lot of pain, not a fair amount, but quite a bit of pain. And I think that's something that's a feature to what we do, because we'll enter a position having data that the market hasn't seen, right, or hasn't digested. And until the market starts digesting that information, you will suffer the pain, right? And that's, it's a basic anatomy of how we do things. But soon after that, you started to see the market revise up to our way of thinking about things. Some of the things we were seeing started being transparent to the market. And at some point, we started thinking about taking profits. We are still gradually offloading the position, but we still have some views on it. Now, in the next slide, I'll then talk quickly about how we build. So, what kind of data do we actually look at? It's the data itself is company specific. So, The first thing is we have scrapers, right? So we have these, you can think about them as web bots. They are just simply out there scraping for data. So in the case of the South African retailers, we actually can tell you we have data on pretty much everything they sell on their shelves. And so most of us would know the kind of articles that are published periodically saying, is Checkers cheaper than Pick and Pay or Woolies? And usually those are looking at baskets. So we have that data, but instead of looking at baskets, we are looking at everything they sell. And when you have that kind of data, you can kind of think about what will happen to market share, right? And beyond that, what's actually happening to price realization, inflation. So if you think about it, the income statement, the revenue line, we kind of have enough data to sort of figure out where it's going. The other thing we were thinking about at the time was load shedding, right? So load shedding was a big problem. If you remember in 2023, everyone was sort of, in fact, the retailers were hundreds of millions of impact in terms of cost because they had to set up diesel and so on. So on the bottom right, we were scraping data on hourly load shedding, and what we did was interesting is we take the hours of load shedding and and combine it with the price of replacing that that cost of load shedding with diesel and whatever else, and we can then estimate the rand impact for each of the retailers in terms of the cost. And what we saw that was encouraging was as we were building up the position, that was leveling off, right? The actual rand cost was actually not being priced in, the fact that these companies were going to save a lot of money. But there was still a big problem, right? If you remember, a big problem was a lot of their stores, particularly the corporate stores, were loss-making, and that was the big puzzle. How will they turn this thing around? So we did a lot of work around this. So the first thing was to confirm or deny the base hypothesis that Pick and Pay is broken, or they've underinvested in their store, or the positioning of their stores geographically is incorrect. In the bottom right, the chart there shows some of the work we did. We used data from Stats SA, superimposed various demographic data, so things like LSM, data, to figure out, if we compare where their stores are located to where other people, so the competitors, is there anything fundamentally broken about their business model? And the data there was clearly, there was nothing we could pick up in the data we were looking at. The other thing we looked at, and this is where generative AI helped us a lot, is we started looking at social media sentiment. So reviews of stores. We looked at over 1 million different reviews of different, and these are geolocated to a store. So we knew which stores were underperforming, and we could kind of figure out by synthesizing all of that data why each store was underperforming. And in fact, one of the core insight was a lot of the stores that were underperforming, it was largely issues of what we call culture, right? Not culture in the traditional sense, but there were things that could be solved with culture. So there were things like, staff are rude and unfriendly. Whenever I go there, I can't find the product that I'm looking for, and I have to go somewhere. These are basic things that are good. And in fact, it's not a surprise why the stores that were underperforming were the corporate stores, where you don't have that owner manager incentive to figure things out. So anyway, this is just an example of one idea and the depth to which we go. So the fact that we use AI doesn't mean that we don't delve deep into what we do. In fact, we delve deeper because we have the data, right? And anyway, so the point is, data is helping us triangulate on an idea and sort of derive these kinds of insights and figure out whether a revision in the views around that company are likely or not. So that's it in a nutshell. Now, if we go just to conclude, in the last slide, I just show the 2 AMCs that we've launched. So the one is the graded, that's the one on the left, that's our hedge fund. It mirrors the hedge fund product that I showed at the beginning. We also have another product, which is the Kyrios fund, which is the one on the right. That is the same core structure. We are investing on the basis of data, looking for revisions, and those 3 types of mispricing. The key difference is we are looking globally and specifically at long only structure, so long equity. and we have a bias. So we are specifically looking within the pool of owner-managed companies, and our data. The reason why we do that is we've seen, firstly from literature, but also our data is confirmed that owner-managed companies tend to outperform, and that's a hard fact. So those are the two products that we've launched, and that's it in a nutshell. Over to you, Simon.
Thanks, Musa. I got to say, your phrase "pain is a feature." I got into Pick and Pay at about exactly the same point you did, but I don't have pain as a feature. I took my money and ran. I think I broke even in the end. Yeah. that's why you got.
It's actually, I mean, it's an important point, because some of the, whenever one uses AI, there's this view that, we should be able to see the future, and we can't. We really can't. So there are many cases where you'll suffer some pain, and as long as the data is still confirming your thesis.
Yeah. And you made a great point. I mean, the way that you're managing the process, you're kind of going to be ahead of the curve, and you've got to sort of wait for the market to catch up with you. A couple of questions coming through. One is sort of talking around the AI and it's asking, have you got bespoke, or are you using one of the off the shelf? I imagine you're using bespoke.
Yes. Well, it depends. So in the screening models, so the screening models that we use are all internally built. The data, I would say 90% of the data we source ourselves. So that alternative data we source ourselves. So we have web scrapers that are running all the time, and that's why you need cloud infrastructure. About 10% we'll buy, right? Because there's no point in scraping what you can get for cheap. Now, on the generative AI piece, there's no point in building a base. In fact, it's cost prohibitive. You can't build a base model that's as credible as a llama, So there you start with a pre-trained base model and just simply do some fine-tuning. So let's call it predictive AI, you build your own, and then for the generative stuff, you just fine-tune whatever you want.
And llama is excellent. I can run llama on my MacBook, and I don't know if that's because of my MacBook or because of llama. Cornette's asking,
no, it's 100%. Sorry.
Cornette's asking, how closely does the pricing performance in the AMC structure mirror the other structure? Is there a difference, or are they pretty much in lockstep?
Yeah, so I think in the initial transition period, there will be differences, right? I mean, because you're still trading into some.
And we seem to have lost Musa suddenly.
Oh, sorry, I pressed the button, it muted. But the point I was making is there will be some initial trading because it launched end of last year, so there's some legacy positions and so on, but the performance will mirror the two.
And then Mpilo is asking how you're able to get the data accurately, and I suppose that is a big part of it. It's one thing to get big data; it's another to get sort of accurate big data, and that is, I suppose, the challenge of your data team.
Yeah, so it depends on which kind of data, but that's obviously the thing that the data team. That's our job, right? That's what we invest in, and it's not a trivial exercise. But to be honest, it's the two big problems are. So once you have data, figuring out whether it's representative of the problem you're trying to solve, right? So, for instance, if we have data on, in fact, so I mean, just as an example, we have a lot of data on food producers, so companies like Rhodes, who else produces, so canned products, because we scrape it. But here's the problem: is for a company like Rhodes, a lot of their products are not, so they are sold to, there are no name brands for some of the retailers. So you might be analyzing the brand and figuring out that it's actually doing well or poorly, but is it representative of the revenue line? Possibly not. So you need to be very careful about the represent. So it's what we call data blind spots. Is having data doesn't mean you've solved the problem. It's but accuracy itself has generally not been, because we source the data ourselves. We know the process we follow, and that's the thing we focus on.
We'll leave it there. I'm not saying anymore. I'm just checking my Twitter. Sometimes I get through there. Nope. That's it, Musa. Really appreciate the time. Ladies and gents, that was Differential Capital. Musa, thank you. Let me switch across to this one, and then we'll get Anil on. Hang on a sec. I'm going to change my sharing to that one. And there we go. Anil, the floor is yours.
Thank you, Simon. Good morning to everyone. Just a little bit of an introduction in terms of the two AMCs I'm going to talk about this morning. Both of these are managed by Standard Stockbroking. So we are very much a sister company of online share trading. I guess the key difference between the two businesses is where the online share trading is very much a direct platform. On the Standard Stockbroking is very much a portfolio management type of service. And really we run a mix of discretionary model portfolios, which is really what I'm going to talk about this morning. But we also do advisory portfolios for clients who are looking for a portfolio manager to assist them in terms of constructing their share portfolios. The two actively managed certificates were launched in 2023. However, there have been discretionary solutions that we've run at Standard Stockbroking for a longer period in time. And our view was, with this new AMC technology that was available to us, it was an efficient way for us to bring that capability to the market. And maybe that's a sort of good place to just sort of unpack why we did that and what we think the value proposition of AMCs are. You know, both of these AMCs that I will talk about today are essentially accessing global markets. The one is a direct share portfolio holding the direct counters, and then the second one is essentially an ETF construction. And really what that does for a South African investor is it allows you to incorporate the AMC just as you would any single share on the JSE into your domestic portfolio. So you're really investing in rands, but ultimately you're investing in major global companies and ETFs around the world, and with the ability to access those hard currency returns. The low minimums essentially we've put on there on both the AMCs at 36,000 Rand investment, and you know that can easily sit alongside all the other shares in your portfolio. I guess one key benefit over a share portfolio is that in a share portfolio, every time you do trade, you trigger a CGT event. Whereas the benefit of the AMC structure is that it allows us to actively manage that portfolio for you. And in fact, the only time that you will have a CGT payment is when you sell the AMC. So in that way, you know, treat it very much like a unit trust. Essentially, you know, I guess the other key benefit is there are a lot of challenges and it's quite expensive in terms of investing money offshore. And often, you know, you'd have to have a fairly sizable portfolio. So, you know, if you want to buy a single share, depending on which of the major companies around the world, you could be paying 2,000, 3,000, 4,000 Rand a single share. Whereas with this particular structure, you're able to essentially, at 36,000 Rand, access to a basket of global blue chip companies. Next slide, please, Simon. So here's a quick sort of summary of the two solutions that I'm going to be talking about. The first one is really what we call our global equity AMC. And this is really where we look to put together around 35 high quality global blue chip companies. And these are really sort of large cap and I would say even mega cap type of companies where you typically would find your NVIDIAs, Metas, Googles of the world. And that sort of minimum is 36,000 Rand. And the JSE ticker on that is AMC 010. Again, what you are able to see here is on a cost, you know, on a total expense ratio basis, you're able to access that at 0.83% per annum. So very attractive in terms of being able to access a blue chip global share portfolio. The second portfolio, which I'll chat about today, is the managed ETF, also a global equity solution. And that one comes in at a total expense ratio of 0.58%. So these are the two solutions that I'm just going to touch on in terms of how we manage them and what essentially you are able to access through these two AMCs. Thanks, Simon. So let's just sort of look at the first one, and this is really a blue chip share portfolio. And what you will notice is that we use the All Country World Index as our benchmark, which really what that means is that we will be looking to invest across the world, across multiple geographies, and accessing what we think are the sort of top companies within their sectors. And typically what we are looking at when you look at this portfolio is many of these companies are within the top 5 players in their industry at a global level. And if not, then they do appear as one of the major players in each of these industries. What you will notice is there is quite a high skew towards North America, and that's really a function of the way the All Country World Index is constructed. But really, at the end of the day, we certainly know that certainly North America and the US in particular is the home to many of the world's leading global companies. However, it's not just an exposure to American listed companies. You will see that apart from US-based companies, we'll also be investing in emerging markets. We'll have an exposure to, companies in India, in China, in the emerging market landscape more broadly, and then also an exposure to Europe, the UK, and other markets as well. Which really what that does is it allows us to build a globally diversified portfolio of roughly 35 high quality blue chip type of companies. If we could move to the next slide, Simon, please. Now, if we look at the AMC or the ETF portfolio, what this is when you look at the top holdings on the right-hand side, that's really what we call the sort of see-through. But in actual fact, what we are holding is a basket of global ETFs. So that could be a mix of like the NASDAQ. Typically, we will be using iShares types of ETFs where you will get access to NASDAQ or emerging markets or Euro stocks, and specific sort of exposures. The ETF portfolio allows us to be very tactical, and this is an actively managed portfolio. So both of these portfolios are managed by our stockbroking investment committee, based on research from our sister companies and our analysts. And really what that allows us to do is to be tactical and responsive to different developments. And maybe I'll just spend a few minutes chatting to some examples of how we've managed this. One of the key developments in the market when you look at the last few years is that the bull market sort of began around July 2022, and at that point, what we saw was the Magnificent Seven, or sort of those top. Sorry, apologies for that. And really what we saw at that point for the majority of that bull market was a lot of the returns were concentrated in the mega cap shares. And certainly, your previous speaker mentioned using AI in the management of their funds. But the advent of the development of artificial intelligence really sort of drove or concentrated returns in a relatively small group of companies. And as a result, we were fortunate in the sense that we held sort of 4 or 5 of these major companies and really performed very well. But as we got to the end of 2024, what we had become aware of is that the valuation dispersion between the US and the rest of the world had sort of widened to the point where even Europe and the FTSE 100 were sort of trading closer to emerging market type of valuations than the US. And as a result, we were able to then tactically shift the portfolio into other pockets of the global economy where we felt we were attracting better value. And that sort of really just talks to the active management and our ability to tilt the portfolio to different geographies, different sectors, and even different styles of investing where we see opportunity. And I guess that's one of the key messages, I'd like to leave with your audience, is that these portfolios are actively managed by an investment committee and therefore will be responsive to developments in the global economy. And certainly we've seen in 2005 significant sort of, geopolitical, economic developments on global markets. Next slide, please, Simon. So how do we sort of create the outperformance? And I think what we are aware of is that essentially, the All Country World Index is probably the best approximation of the opportunity set for investors looking to generate excess returns. So we use that as a reference point or a benchmark. But within that, there's quite a bit of complexity. So within that, you're going to have, a variety of geographies, but also, roughly about 10 different sectors, whether we're looking at technology, consumer discretionary, consumer staples, energy, utilities, etc. So our focus is really to look at that benchmark and identify which of these different sectors we see opportunity, and then be able to access that and essentially buy the best stocks in those particular sectors. So at certain times we'll be overweight technology, at other times we'll trim that back and to a neutral or an underweight position. And that's really the ability to respond to developments in the market. And really one of the key elements in managing money, I guess, is really around risk management. And risk management is something that is very important in our investment process, because ideally what we are looking to do is create a diversified portfolio. One of the ways we do that is by holding 35 counters, but also diversified across geographies, and then also in terms of sectors as well. And using that as a reference point, that allows us to be able to tap into the global economy and shift the capital around as needed, depending on what the opportunity set is presenting at any given time. Thank you, Simon. So a quick summary of performance and certainly one of the ways we look at markets. So if we look at sort of the returns as an example across the world over the last sort of 12 months, so these are 1-year returns to the end of April. And what you will notice is that, and these are in US dollars, what you will notice is quite a dispersion between returns depending on which geography you look at. Now, certainly you'll notice, interestingly enough, that South Africa over the last 12 months was one of the top performing markets. And I guess that's a combination of various factors. We've certainly had a very strong run on the domestic market in the precious metals sector in particular. We've also had a relatively strong rand, and currency is another factor that comes into the equation. But China in particular, has really languished coming out of the post-COVID environment and sort of really lagged the American market significantly for much of this the current bull market that we are in. But about a year ago, we sort of identified that, with sort of the Chinese valuations, when you look at the Chinese technology companies relative to the American technology companies, they were starting to look very attractive. And when I talk about these Chinese companies, I'm really talking about the major players, in the tech and consumer discretionary space, such as Tencent, Alibaba, etc. And China's essentially rebounded very nicely over the last 12 months, and we've seen some good performance. With this, we still think the market's relatively cheaply valued, considering the risks in this environment. And then more recently, we've seen a nice uptick in the FTSE and European markets as well, as these markets had just become, very cheap. And a lot of the capital over the last few years had been flowing to a small group of technology companies in the US. And as those valuations got a little bit more stretched, global investors started to look for returns in other pockets of the global economy. So this sort of is one of the sort of key measures. On the next slide, what we really look at is the sector breakdown. So the geography is certainly one element of it, but then we also want to be able to look at companies in different sectors. And one of the key things with global markets is at different times, different sectors will lead or lag, depending on what the sort of specific dynamics are in that particular industry. Energy, as we know, has been under huge pressure. The oil prices sort of come off considerably. And on average, you know, a lot of the old tech type of energy companies have really come under pressure as people have moved away from fossil fuels and put pressure on for the development of renewable energy. So really, energy has been sort of the worst performing sector over the last 12 months. We think there's reasonable value in there now, and certainly our outlook is not as negative now as it was a year ago. But really, sort of, if we move to the other end of the spectrum, financials in particular have benefited, and utilities as well. Utilities have really sort of been probably one of the cheaper, more defensive, you know, sectors of the market. And as uncertainty around earnings and the global economy is developed, you know, a lot of investors have moved into utility type companies, attracting, you know, fairly fat dividends and low PEs. But essentially, when you look across the board, you know, the two key factors for us are the geographic valuations, but then also the sector, you know, the sector valuations. Our process is really a bottom-up process where we choose stocks based on their individual fundamentals, but we remain very cognizant of what the sort of global themes are playing out, and particularly the sectoral themes. If we could go to the next slide, please, Simon. Yeah, so I won't spend too much of time on this particular slide, but it really sort of talks about year-to-date returns, and I guess year-to-date is really sort of bringing into fore some of the key developments we've seen from the shift in the US administration with the November 2024 election. And that I'll touch on that a little bit in the next few slides, but certainly that has become quite an important macro factor as the geopolitics, the trade negotiations, and the tariffs have played out. And certainly what we have seen in the last month is quite a bit of volatility in the market. So I'm just going to touch on that over the next few slides and sort of just give you some of our thoughts on how these themes are playing out. I'll just skip through this, Simon, if we could perhaps go to the next slide, please. There we go. So as we stand right now, when we look at the global environment, you know, I guess the biggest change that we've made to where we were from about, you know, the end of last year was we've upped our percentage or probability of being in a stagflation environment. And really what that's talking about is that we see, you know, growth being fairly muted this year across the world. Certainly the tariffs and the concern around that has probably put corporate action a little bit on hold. Some of that capex may be delayed. And when you put that all together, that uncertainty should, you know, act as a headwind, together with the potential for tariffs, act as a headwind to slowing the global economy. But at the same time, you know, inflation remains benign at this point in time, but also fairly sticky. And that sort of puts the global economy in an environment where you do have upside pressure to inflation and a bit of downside pressure to economic growth. And in that particular environment, we felt that it was appropriate to increase, you know, our probability of a more stagflationary environment. Now, all of this can obviously change. And I guess, you know, when you think about the Federal Reserve and how the Federal Reserve will respond to developments going forward, you know, the Federal Reserve at this point has been reluctant to cut rates as they've sort of, I guess, taken a wait and see approach to see how the impact of the tariffs will impact corporate earnings, unemployment, and just economic activity at that point. Fortunately, they do certainly have room to cut rates, and I think that we remain fairly constructive that we will get some cuts coming from the Federal Reserve this year. Timing is always tricky, and I think it's very data dependent. So I'm not sure that they know exactly themselves when those cuts will come through. And I guess that's something we will, you know, will be driven by the data coming through in the months ahead. Thank you, Simon.
No,
and then just sort of lastly, just touching on that.
I was going to say, to your last slide, yeah, we'll run through this, then I've got some questions. I also got some thoughts on your points here, but touch on these and then I'll catch up with you.
Yeah, I guess, Simon, just really just a couple of thoughts. I know the tariffs are quite topical and we've seen quite a bit of to and fro around that. And I guess, a lot of that sort of market volatility began with what was, called the Liberation Day on the 2nd of April, where, blanket tariffs were imposed across a wide range of countries. Since then, we have seen that being paused. We've also seen some positive, I guess, signposts coming out of the US-China discussions. And all of that has sort of, turned quite significantly. And we've seen quite a V-shaped recovery in the markets in the second half of April after what was a very difficult first week in April. Our sense is that, the markets have discounted a lot of bad news. And from what it seems like, and it's still early to tell, but certainly what it seems like is that it's not going to be as bad as the market was, discounting at some point. We will have a lot of talking points coming through as we approach the end of the 90-day pause. We've seen a deal between the US and the UK. We've seen the US administration in the Middle East. So, all in all, we suspect there's a lot more good news coming out of this, and perhaps, the market scare that we had in April is not going to turn out as badly as we expected. Thanks, Simon.
Yeah, and of course, our own president is heading to Washington next week. Yeah. Thanks, I know, appreciate that. Ladies and gents, if you've got some questions, drop them in the Q&A box. A couple have come through. And one knows more clarification, which is, on the tax event, you the AMC doesn't pay tax internally, so there's no drag there. You don't have any issues, as you say. It's only when we exit as the individual that my tax liability then comes in.
That's perfectly correct. Yeah, exactly. So while you're holding a global portfolio inside the AMC, we as the portfolio managers will actively trade it, but it's only when you sell the AMC and you look at what the capital gain has been, that particular amount will be subject to CGT. So there's no tax inside the structure as such.
Yeah. Cornette, you say, just to confirm, an investor's offshore allowance isn't utilized. That would be correct. You're buying in ZAR and then on the JSE, and then Standard Bank is doing that conversion. Dennis asks an interesting question, difference between an AMC and a listed investment trust. I mean, the only one that comes to my mind, and of course we don't have as many listed investment trusts as we did back in the day. It depends how that trust is structured, but in some ways maybe similar.
Look, I'm not really very familiar with listed investment trusts, so I'll be cautious on commenting on that. What I will say to you is that you probably from a tax perspective, your key reference point is the holding of a unit trust, and that's sort of a closer representation from a tax point of view.
Yeah. Actually, that's a good point. And I'm thinking of, for example, two listed investment trusts that come to mind for me. Locally, I suppose Remgro. Offshore, we would look at Berkshire Hathaway. If Remgro sells something, they have a CGT event within the trust. The flip side, of course, is they get some permanent capital coming through. Another question came through asking around your slide there where you're talking around in your probability of stagflation, etc. Question is, how often are you updating that? Is it sort of as you need, which so far in 2025 sometimes might be twice a day? But I'm imagining that's something you're keeping a close eye on, to the probabilities and whether you think you're in the right sort of levels.
Sure. Thank you. It's a good question. If I just look at sort of our probability weighting, we've essentially made one change in the last sort of 12 months, and that's been a major change. So when we look at that from an economic outlook, we tend to have a more strategic sort of view on that. So we won't, the day-to-day fluctuations don't typically affect that so much. What we would be looking for is a confluence of fundamental factors shifting in a particular direction that says to us, we think we're in a different type of macroeconomic environment. Clearly, those inputs are certainly, fiscal policy, monetary policy, corporate earnings, economic data, so a whole bunch of those. But we tend to look at it more strategically, which means that, it's not to say we won't make changes more often, but typically, on average, that will shift once or twice a year type thing.
Yeah, I take your point. Things are changing, but you don't want to be sort of changing your view that they're happening sort of in the background. Kenneth, you were asking how actively managed. I think that question has been answered. A question, kindly advise how we can invest in these two AMCs. Silvio, there's the details. So it's literally you log into your JC brokerage account, any JC broker. Codes are AMC 010 and AMC 011 for the two different ones, and you buy them on the market. Nice and simple. That is one of the very big attractions. Your cost of transaction will be whatever your broker charges you, and then of course the total expense ratio, which is the component which essentially is the manager fee. I'm not seeing any more questions coming through. I don't really appreciate your time today. Ladies and gents, appreciate your time. We are back again next week for the final in the series. Everyone look after yourself, and as always, if you can, look after somebody else as well. Thanks all. Thanks, Anil.
Thank you, Simon.